welcome to this special webinar today evening. We've been doing a lot of these webinars to engage with all of you. Markets have obviously been very challenging, and I'm sure all of you are anxious about health, the economy, your business and portfolios, I guess in that order. But today is a very, very special webinar, and I can see the excitement because already I think this is a record turnout. We've never had, we are clocking right now 740 participants. I think, Raamdeo, this is a record for us actually. So I can feel the excitement in people today. So this is a special webinar because as a lot of you are aware, this is like a once in a year kind of event which Raamdeo never misses, which is the Buffett AGM. If I'm not mistaken, and whatever I've heard from him, he's been going there for, I think this must be the first time he's not gone in the last 25 years. Is that correct, sir? Since 95?
No, I missed 2-3 times. I missed 2-3 times.
So about
from 96 till date, I think I must have done about 22-23 times.
Right, and I've personally been very lucky to be on the couple of these trips. It's a fantastic event where the auditorium is full, and it's basically a celebration of capitalism and stock markets. Of course, one of the main benefits of going there is every time the Sage of Omaha has some pearls of wisdom that he drops, and obviously you have to figure out what are those pearls of wisdom and see how that is beneficial to you. So without any further ado, we thought, instead of trying to go through the entire AGM transcript and watch the 5-hour telecast, who better than Mr. Raamdeo Agrawal to decode it to us today and also share with us some insights, frameworks that he's gathered in the recently concluded AGM. Of course, it was a very different one with the auditorium completely empty with just Buffett and Greg Abel and Becky Quick asking him questions remotely. More importantly, Mangar not being there. So without further ado, Raamdeo ji, I will hand it over to you. Now, once Raamdeo ji spends maybe 20-25 minutes, whatever is comfortable with him, sharing his thoughts on this AGM and his learnings or any insights that he gathered. We also have with us Mr. Navin Agarwal, who's the MD and CEO of Motilal Oswal Financial Services. I will request him to share his perspectives as well and what it means to us here in India, and is there any takeaways for our markets at all? And then we can dig into the Q&A. So I would encourage all the participants to post their questions in the Q&A box so that it's easy for me to curate them for Naveen as well as Raamdeo ji. Raamdeo ji, over to you.
Okay. Yeah, so welcome to this webinar and good evening, friends. It's a pleasure to be talking to all of you. And since it is not about today's market, whether it has gone up or down, I think it is a pleasure talking only about Buffett seminar. And earlier, I missed this time because it is not only attending the seminar, you used to meet so many new people. And it is the world's most coveted networking event for the value investors or investors per se. And with the introductions and with the friends and friends of friends, you get to meet some stunning guys. You could be talking to anybody out there and you would not know he's managing 200 billion or 300 billion, or he would be a fund manager in a, last time I was going, I flew from here to Toronto. Somebody told me that Mumbai, Toronto, Omaha is a fantastic way. So I took up that flight, wonderful flight from here. And in Toronto, when I was boarding for the flight to Omaha, all the guys who were going from Toronto to Omaha, they all boarded with me. And there I saw all my clients and some of the, all this pension fund managers, those who are managing about $500 billion, $250 billion, they were all with, I could meet them for a few hours on the flight. So you can meet so many interesting people out there. So I missed that. But nevertheless, I think it was a fantastic experience. And I think this time Mr. Buffett had done a special effort to explain his situation because he was knowing the expectation from him is very high and the situation is also extraordinary. So he came with some 10, 12, 15 slides presented on. I was actually stunned that he has taken so much of pain to explain the situation. Actually, he didn't speak so much about the performance of Berkshire Hathaway and its own businesses, but he actually spent a lot more time in explaining the history of capitalism, history of America, history of prosperity of America, and how it is invincible and how one must not bet against the how much one must not bet against America. In fact, listening to him, you would like to definitely put few percentage of your portfolio into American stocks. So he started. Let me just. I have my notes. What I will do is that in the chronological order, as he spoke, I have prepared my notes. What struck me, that portion only I have noted down. So first he talked about 231 years of U.S. History even before independence and the kind of slavery and those kind of things were there. I think there was a civil war, and in that 5% of the population died, something like that. So it was a terrible time in US, and from there also US could come up and got independence, and then it has become what it has become. So he said from all the adversities US has been able to come out, and he doesn't have any doubts that even from this adversity US will come out. So never bet against America. That was his theme of the presentation. But while he was talking about this history of America and particularly Dow and the stock market, he talks about first thing he talks about is that in 1929, 1930, because he must have been about he was just about born in 1930. He was born. So in 1929, Dow went down from 300 odd to 200, and so that was quite a sharp drop. And then it pulled back from 200 to 250 or something like that, or 240. So everybody thought that after 30% decline, it has pulled back 20%. So everything is fine now. I mean, things will start recovering, and whatever had to be done is done. And then, I mean, unknowingly, I mean, the history tells that Dow from 30th September 2030, it was 240.42, up 20% from the bottom. On 8/7/32, that was almost 2 year henceforth, a little less than 2 years. The Dow fell by 80% to 41.22. So he's saying that don't read too much into. I mean, this nature of the market is absolutely unpredictable, and it can be. I mean, if he had to speak on this, it means that his inner voice is telling him he's a very wise person. I mean, in 90 years of age, what he has not seen, and I mean, I still remember in 2005 or I think 2005 or four when he took a General Ree. That time he said derivatives are weapons of mass destruction, and it took him 3 years to pull out of all the contracts which are running into few $1 billion at a cost. He pulled General Ree from those derivatives contract. Otherwise, in 2008, the same contract would have doomed for General Ree. So they could see the problem which were coming in financial markets way back in 2005, full 3 4 years ahead. So they have a fantastic understanding of risk. I mean, actually, if he has survived throughout and prospered, it is because they have a sixth and seventh sense of understanding from where risk can hit them. Because you are the world's biggest net worth company and you are the world's #1 insurer. So you can imagine how sharp and how deep your understanding of risk has to be. So that was the kind of thing, and then he says that Great Depression tainted people's mind much longer. So the market declined for in 2 years by 80%, but the people's mind got completely corroded, and they got in fact depressed, and that consumer, the citizen mindset it took much longer for them to come back. It was in 1951, after 20 years, that the Dow came back to 240. So he was recounting between 1930 and 250 and 1951, and he's giving the reason for depression to the consumer mindset, the citizens mindset. So more than COVID and what happens to the businesses, it is about the consumer, because the whole economy is designed around consumer. So he's saying that how these kind of depressions or shocks, they change the mindset of the people that nobody knows. So that he was just bringing it on the table. So he says he doesn't know about the market, what will happen, but uh, yeah, so he was saying that he doesn't know what the markets will do in the short run, and in the long run, America will win, and he would advise anybody to own cross section of the businesses, which is basically S&P 500. So he ended up recommending S&P 500 ownership by mass people who are not good in picking stocks, or is able to manage their own portfolio without any this thing. I mean, he mentioned 3 4 times. Mm, yeah. Then he talked about aviation. I mean, obviously, one of the fallout of this entire discussion was the decline in the. I mean, all the airlines are bankrupt. They have stopped their services. Planes are lying on the ground. So he said they realized that the damage is too deep, and the mistake is that of his in investing it. He badmouthed the industry for 20 25 years, and then he became the ultimate bull in the on the aviation, and he bought 10% limit on the all the 4 airlines, and he sold it in one shot, of course at a loss. I mean, some kind of a loss, maybe 20% 30% loss, but he cleaned up everything. He says when we change our view, we change it forever, in the sense that we don't want to do it 20% 30% 40%. We cleaned up completely. So when he bought from 0 to 10%, and when he sold from 10 to 0. And then he says that about investing, why he is not buying. He's saying that they still don't see it's running gold. They don't see there are some very lucrative deals out there in the stock market. At least for the large deals, they don't see that kind of opportunity. He is very clear about that. But he is very long-term bullish even at the current level. But in the short term, he doesn't see very deep value in the marketplace, at least in US. And he's saying that fear is the most contagious disease you can imagine. It makes virus look like a pup piker. I mean, he used the word pup piker. It must be some cartoon character or something. But I mean, he is very clear that the fear is far more dangerous than the virus itself. So the fear of virus is what leads the market to fall or rise. And as this COVID thing starts becoming longer, and damages many more businesses for much longer period, I think as the results come out, as people start counting what is the damage, because still this is not the time to count the damage, because the event is not over. I mean, there is a lot of hope that vaccine is coming or killer medicines are coming, but nothing is on the in the place. So as the event ends, which it will, maybe in 6 months, 3 months, 1 year, and then you can count the damage. So he's saying that we are in complete unknown, and so I would not like to speculate. So, and another thing, another wise thing he's saying is we don't need it at all. We mean never want to be, we never want to be dependent on the not only the kindness of strangers, but the kindness of friends. He knows that if he gets into any kind of difficulty, liquidity trap or something, he can call up treasury and get money. But he doesn't want. I mean, he's fearing something very bad, basically. And I mean, there is some possibility that things could be very bad. And there he's saying that he doesn't want any kind of situation where he may have to seek help from Fed or bank or somebody for the liquidity. And hence, he thinks that for the type of businesses and the amount of underwriting they have done in various businesses. He doesn't like that 125 billion is huge compared to the compounded risk they could be in. See, what he's saying is that one problem leads to another in this kind of situation. So they are very clear that they don't know the event itself, the end of the event, and hence they don't know the size of the risk they are facing. Because in fact, at that point of time, I sent a question which was never asked. What is the total gross value of the risk he has underwritten? Is it a 15 trillion, 20 trillion, or 30 trillion? So it's some crazy amount of number. And if by chance many claims come together, he doesn't want to be wanting to be seen not being able to pay. So I think he doesn't want. He thinks that 125 could also be less. So actually, he has shown. I mean, after selling that $6 billion, $7 billion worth of airline stock, I don't think he has done replacement buying. Second, I think he has. I mean, I saw some news reports that he did float some bonds at zero coupon in Tokyo and Europe, but not very big amount. So he's actually wanting to sit on cash of even larger amount than what he has. Then he goes to say that buying stocks depends on one's own understanding and one's own circumstances. You should be happy holding the stocks. So this was a good one. He said you should be holding a stock and be comfortable with the stock, even if the stock is down 50-60%. And it could not. The stocks can come down without any fault of the company. The company may be perfectly all right, but the stocks can fall way below the current quoted price, and you should be comfortable because you have bought the company, you have not bought the price. So he's saying that you should be very comfortable, perfectly comfortable, even if the stock falls by 50-60%. Basically, he's saying that your understanding of the business, the intrinsic value should be very, very solid, and you have to fend it for yourself, because this is the time when the manager, I mean, whether you are the manager or some other manager, they have to fend for themselves because logic is going haywire every day. So he's saying that be comfortable, even if you buy something, there is no mistake of the business or the manager, which is what has happened in airlines, and all the airline stocks are down 60, 70, 80%. So he's not blaming the managers, he's blaming that his own risk architecture or his own understanding, I mean, lack of understanding of the risk underlying the businesses. Then he goes to say that then he's saying that not only that you are buying something what you understand, and you should be willing to see stocks coming down and you should be comfortable, you must buy for very extended period. Earlier we used to talk about 2 years, 3 years, or even 5 years as the long term. Probably you could be in for a much longer wait. I mean, he's drawing, my sense is he was reading too much into or he was drawing parallel with the what happened in 1929-30, and it took 20 years for the markets to come back to the original level. So he's kind of saying that you could be in for a very extended period of depression. That's what was coming out, and and he's saying that even handling this fear of decline, some people are much better wired and some people are not. And that I have seen among the clients. Some people are pretty cool. Their NAV is down 20%, 30%. They'll say, Raamdeo, how are you? And they'll be pretty happy being in the same boat. But some people, they panic on every 2%, 3%, and they'll say, sir, should I get out? Sir, should I sit in the cash? So, every person is wired differently, and hence your allocation and your allocation and what you can stomach, what kind of stomach you have for the equities, you have to check and do it accordingly. So finally he says, I don't know whether today is a great day to buy stocks. It will be fine if you own it for 20, 30 years. That kind of talk he's talking about. Yeah, and then he says some businesses turn out to be better than you thought at the and some worse. Over a period of time, the time will judge how was your batting average. So buying good businesses versus bad businesses. Sometimes, like I think it is in the backdrop of airline business where he thought with the consolidation of the airline industry in US and booming economy, he has got into a reasonably good business, and it turned out to be as bad as what he thought before. So he's talking about that because you take a view that this business is good, and then later it turns out to be worse than what you thought. But what happens is if you have a habit of buying only good businesses, there will be some businesses which will not turn out to be as good. But the batting average is what is important. If out of your 10 calls, if you are able to get 6, 7, or 8 right, and 2 as a dud businesses, I think you're doing fine. So it all depends on the long term, how good is your call. So you are dealing with a huge unknown, don't know how it will behave in next 6 to 12 months. Uh, size affects his performance, and there he I think he ended up saying that at 370 billion odd he's managing, uh, it is the world's largest net worth company. I mean, this was a news to me. I didn't know. I knew that his market cap is about now it is about 420 billion. I think it had hit a high of about 500 odd billion. It had crossed half a trillion. And I thought this was the first company started by, I mean, like chaired by this person, and in his own lifetime, it will be the first company which will hit $1 trillion market cap right under leadership of one guy. So, but now at 420 billion, it is world's largest net worth company. There are much larger market cap companies like Amazon, Microsoft, or Facebook, and Google, but they are not. Their net worth is not that high. Their price to book is very high, and hence net worth is much lower. Here, price to book is 1.2, 1.3. So 370 billion is at 420. So I think you are talking about 1.2 book. So this is the world's largest net worth company, and I think some of the problems come because of the very size itself. Because to make any difference, he needs to buy something which is worth 20, 30 billion, and since his entry is difficult, exit is even more difficult. So he cannot afford to buy low quality, and at the same time, he also cannot afford to buy very expensive. So he has to buy high quality, reasonably good quality, and that too with a good margin of safety. And getting both today is a big challenge for him. So those were the kind of notes I picked up while listening to him, and we have mentioned this. And so, I mean, that's what it is. I mean, it was a good listening to him for about 1.5, 2 hours. Ashish, it was 2 hours. His original presentation.
Yeah, it was about, I think, 2.5, three, I remember. And then there
Yeah.
was Q&A by Becky Quick.
Yeah, so the Q&A just repeated a lot of things, but basically his own presentation was the main feature, which was completely designed by him, and it was uninterrupted by what he wants to say. His flow of thought was uninterrupted, and he clearly, I mean, today it see the disconnect between the market perception and reality, the disconnect between the fear in his mind and what is visible in the stock market is I mean, we are floating in the mindset of what the market is today, and he is able to probably for his age, for his wisdom, for his experience, whatever he's seeing, and seeing in America is very different from seeing in India, because Indian American economy is very different in size. The depth is very different. He sits on a Himalayan top. We sit on the ground. So, I mean, the view is very different for everything. So I would definitely take it very seriously. I don't wish his dire predictions come true. He has been, let me tell you, uh, he has been very wrong in most of the macro calls. He has been horribly wrong. I remember in 2008, I mean, I was attending the we can go and check the 2008 this thing. Actually, the whole audience was worried about this mortgage crisis. So when it collapsed in 2008, in say it collapsed in sometime in September or something. So in May of 2008 or 2007, I don't know. The question was very clearly there, sir. What is going to happen to this mortgage crisis? I mean, mortgage started slipping, and the ratios were deteriorating for the lenders. So he said the economy is so strong that whatever is the difficulties, whatever is the slack in the housing market, that will be taken care of by the new jobs which will be created. So he completely wished it away. I'm talking about 6 months before the collapse, just 6 months before the biggest collapse America ever had. And a question was asked point blank on that particular subject. So whosoever was asking question, probably he had already shorted the market or whatever, but that guy was more insightful than Buffett. So I don't think he has a great track record of calling on the macro. So we must take it with pinch of salt. I mean, you must go by your own understanding of situations, but also you must not ignore the framework he has brought about the 1929, 1930, because ultimately everything happens there. If US sinks, India cannot be floating. I mean, we'll all sink or swim together. Not so much about the economy. I mean, maybe we can do much better than them because we are the economy of essentials. They are economy of discretionaries. They are very large. They can be impacted by US-China war. I mean, the differences or consumer behavior. Their consumer behavior is very different. I mean, they are about Disney, Las Vegas, conferences, tourism, driving. We are not about them. Our biggest discretionary spends are marriages or some religious tourism, those kind of things. So those are things broadly will come back. Indian economy will come back. But I think in stock market, if US goes down by 30, 40%, I don't think we have guts to go up 25, 30%. And in fact, today, the exuberance I see in India is not because of what we have done or what is happening in India. It is more because US futures are up. So that's what decides right now in the short term. And hence, as the markets, broad markets are taking cue from US markets, and US markets are taking, is the best commentator is Buffett at this juncture, at least on macro or whatever he can see from there. I think we should reflect in our own understanding and what we would like to do.
Thanks a lot, Raamdeo. I think that was a very, very insightful talk, and a lot of insights which were shared by Buffett. You distilled into a 30-minute talk, so that was fantastic. I just hand it over to Navin now. Navin, if you could share your perspectives, because you've also seen our framework and businesses evolve around the Buffett, if I can say, AGMs over the last 25, 26 years. And if you have any questions for Raamdeo ji around the recent AGM, over to you, Navin.
Yeah, hi everyone. So I have not attended as many meetings as Raamdeo ji has attended, but ever since this whole annual meeting has been broadcasted on this Yahoo Finance, I haven't missed any minute of these AGMs as well. And while I was, I did not get as many insights in the 2019 and the 2018 AGM. I think because of COVID and because of nobody being there in that large, place, really Buffett took a unusual amount of effort to be putting together at the age of 90 a PPT, which most 30, 40-year-old people may also be hesitant to do. So fantastic, learning experience, enriching experience for, I think, everybody who has been a follower of Buffett. And usually I recount that there are huge, because Buffett thinks of stocks as businesses, there are huge business learnings from all his AGMs over the last so many years. So any businessman should actually, as much as an investor should see the AGM, should also see these AGMs, because there's really a hell of a lot to learn for businesses, because really he's a business investor, in the garb of a stock investor, and now even more a business owner than, stock owner. But this AGM was very different in the sense that the amount of history in this AGM is something that I have never ever seen before. And while the history of the US from the day of its independence is 231 years old, as he mentioned, Indian history from its day of independence is only 73 years old. So for us, actually, we are very lucky to have these context of 2 centuries when we, and what I found remarkable was Buffett thinks that at the age of 231 in 2020, United States is incredibly young, as he said, quote unquote. So if US is incredibly young at 231, US was basically born in 1789, and we had George Washington, who's equivalent of Sardar Vallabhbhai Patel, who united all the states in and also led the War of Independence to throw the Britishers out of that place. He was the first president. So since then, US is now 231 years old, and he went on to cite that several years later, at the age of 74 in 1863, the then president, because this civil war was going on, in the middle of the war said that this war is testing whether this nation or any other nation so conceived and so dedicated can long endure. Meaning the president of the United States at the age of 74, we are 73 years old, at the age of 74 was doubting whether a nation which was so dedicated would actually continue in the current shape and form. So, what is really the point of these history lessons? It's really that if the US can endure the civil war that lasted 4 years, ending 1865, then COVID is really a small fry. In fact, he took a lot of pain to explain the context of how damaging the civil war was. He said 6% of the entire prime age males died in that, in that civil war. And if you were to equate that to today's American population, that population works out to 4 million. And I was just seeing at the last count, the number of COVID deaths in the United States are at 72,000. And hell has obviously broken loose. And we've seen one of the biggest falls in a single month in the month of March there. So, basically, if there were dark clouds that were so thick that at the age of 76, they were unsure after 6% of the prime age male, which was the entire working population there, died. At the age of 73 in India, I think we will definitely endure, whatever you guys feel is wrong with the country. Yeah. So that was one thing that I really found, contextual to India. And the other thing that was very similar was that he talked about the US Declaration of Independence, which was penned in 1776. The Declaration of Independence said, we hold these truths to be self-evident that all men are created equal. And in the first census in 1790, they discovered that, and he again, I don't know from where he found all this data and took all the effort, but on a population of 2.9 million, 0.7 million population was slaves, or almost, whatever, 15% of the population was held, or more than 15% of the population was held as slaves. So, again, he went on to say that it took 131 years until women were allowed to vote in America. And then after that, it took another 61 years for the first woman to join the Supreme Court there. So, this was, after writing this in the Declaration of Independence, it took so much time. So I'm only highlighting all this because all of us, if I ask you, you will narrate a list of problems that India has, right? I think we know the problems. What we don't know is where we are in the history of our own independence. We are just 73 years old. And, after 131 years, women were allowed to vote. After 192 years, women joined the Supreme Court. So I think in many ways, it makes you feel a little better, than you feel many times when you are, bogged down by the problems that present India. Also, the theme of the meeting was "Don't bet against America." Now, the data that he gave again, and I think only Buffett could have estimated all this. I can't imagine any history book containing all these statistics. He estimated that at the point of independence, which is in 1979, the total wealth of America, meaning all the land, all the gold, everything that they owned, was roughly worth US dollar 1 billion. And he puts a disclaimer that this is a wild Buffett guess. It could be wrong, but I think anybody else in the world making this guess will have lower credibility, and Buffett making this guess will have very high credibility. And we are in 2020 now, and the estimated wealth of United States in 2020 is about $100 trillion. So $1 billion becomes $100 trillion over these 2 centuries, really, just over 2 centuries, which is 100,000 times, a lakh times increase in the nominal wealth of the United States. And then he goes on to say that, let's assume inflation is 20:1, then the wealth in real terms is still up an unbelievable 5,000 times. And mind you, this 5,000 times real multiplier and 100,000 times nominal multiplier is for all the wealth, including land and everything else, real estate, gold, bank deposits. I mean, really, equities would have actually compounded much better. So the context is that Sensex was born in 1979 at 100 points, and we are at, let's say, 30,000 points now. So in nominal terms, we've multiplied only 300 times, and our own next 300 times is still ahead of us. It may take some time, but it's ahead of us. So really, don't bet against America. I'd say don't bet against India. So, these are very long-term thoughts. They are not really relevant for how do you see the markets in 2020? What is happening to the Indian markets? What is happening to the US markets? But this really shows, the inevitability of, equities as an asset class, how thinking long-term, how optimism can help you tide over, crisis like the civil war in the US, and how, many imperfections that you see in the economy and problems that you see in the economy actually endures all of that, notwithstanding the doubts, even at the highest level, including the president of US. Turning to the next section, which is beyond the history section, what I really enjoyed was, or liked was, all the thoughts, around basically the admission of the mistake of the airline purchase. Now, I was just thinking through, we have made as an AMC some mistakes over the last, 14, 15 years of plus of active money management. But when I look back, I realize that an individual investor, will never ever be able to walk out of a mistake as easily as we've seen here. In fact, I was wondering that if I look at many professional investors, they too will get bogged down by not what is the right thing to do. They're probably smart enough to know what is the right thing to do, but bogged down by how will it appear? I mean, when I'm doing this, how will it appear? So, Warren Buffett has a lot of skin in the game, and so he doesn't. He will swallow the ego. He will admit the mistake, but when facts change, he will change his mind. So he will do what is right, however stupid he may appear. And I've seen Raamdeo ji do that, and we've had a lot of arguments with him internally sometimes on some names. But I think when you have a professional investor, when you have skin in the game, really you can really walk out of your mistakes. So this is something which is I would say unique to only a handful of investors, and not everybody can swallow the ego and move on. So that is something that I found interesting. The last thing that I found interesting was this whole he's wise, he's successful, he knows history better than all of us, but bear in mind that he is in touch with the world's smartest people with expertise on COVID. So he talked about this guy called Sam Nunn, who's a former senator and a founder of the Nuclear Threat Initiatives. he has a YouTube video, which I would recommend all of you to see. And he was surprised that a video which is dating back to 2015 has hardly been seen by many people. But the title of the video is "Germs Don't Have Borders." So there are people as smart as Sam Nunn who came actually and presented in 2019 personally to Buffett, because maybe Buffett is working with Sam Nunn on some of these things, about a possibility of a pandemic like this. So he talks to Sam Nunn directly. He talks to Bill Gates directly, who's an authority on the subject. He talks to Fauci directly. So he's talking to the best of the minds. And what does he have to say on this? He says, quote unquote, at some stage the virus will come back. So please don't be sure about yourself. The virus will decide our response over the next 12 to 18 months. And it goes on to say, and again, quote, anything can happen in terms of the markets. And while you bet on America, right, but you guys have to be careful about how you bet, simply because markets can do anything. And then after this, he goes on to give you 3 examples. Example number 1, that markets were down 22% in a single day on October 11, 1987. I don't know why he had to bring this up, but he brought this up. It goes on to say that markets were shut for 4 months in 1914, right? I didn't know about this actually till I heard this here. And then he goes on to say that markets were shut for 4 days post 9/11. So anything can happen in terms of the markets. While you don't bet against America, you better be very careful, when you're investing, because anything can happen to markets. So, he when he says that at some stage virus will come back, don't be sure about yourself. Anything can happen in America. Markets fell 22%. They were closed for 4 months. I think when he puts all of this in a paragraph, in a section of his presentation, we should listen, because listening to wise people is always useful. And then we know that he has cash of $137.3 billion, right? This is the biggest cash that he has owned. And what has he done till date? In the calendar year from January to April, Berkshire Hathaway has net sold $4 to $5 billion. They sold $6 billion in April alone. Now, I understand that their views on airline business has changed for worse. But what is more notable for me is that despite one of the biggest falls in the history in the month of March, their views on nothing has changed for the better. Their views on airlines have changed for the worse. Their view on travel has changed for the worse. Their view on theme parks have changed for the worse. Their view on nothing, absolutely nothing, has changed for the better. Also, what was surprising to me was that their view on Berkshire, which itself fell, Berkshire had seen a high of $350,000. It's now down to $240,000 at the low. It's down 30%. But they think that, maybe the intrinsic value is also down 30%. And this man is really wise, so you better listen to him. And so Buffett is not backing up the truck on stocks, while global and Indian markets have bounced back by 20%, 30%, depending on markets to markets, on the back of the actual stimulus in the US or Japan or Germany, or the expected stimulus, or the arrival of the antidote or whatever else. But you need to be careful, and you need to, listen to this guy. So I mean, I think he left us with reasonable degree of caution, a lot of historical illustrations, asking us to be careful about, how to think about the future. And, usually all falls will lead to bounce backs, all stimulus will lead to markets going up. But just that, at least what I took away from Buffett's AGM from Buffett is that, this is not, you should be cautious. Yeah. And the last thing was that, he always in his, and I look forward to that, he keeps recommending great books to read. In his AGM, almost every time he's recommended 1 or 2 books. Many of them are new books. This time around, he's recommended The Great Crash by John Kenneth Galbraith. So that's one book which I think many of us may not have clarity of history as well as Buffett has. but I think this book may be useful read. The other book that he recommended was Keeping at It by Paul Walker. So, and then this YouTube video by Sam Nunn, I think Germs Don't Have Borders. So some of these resources, these couple of books and videos, I think may be useful for anybody in the audience to also consider reading. Yeah, so those are just a few thoughts over and above the stuff that Raamdeo ji articulated. Over to you, Ashish.
Right. Thanks, Naveen. Anything that you'd like to, ask Raamdeo ji in terms of the AGM or any takeaways?
Yeah, I mean, so we talk every day about the markets, and so one of the things that often happens is that in every they say that at the bend the leadership changes. So whenever there is from a race course terminology point of view, so there is a bend right now, COVID bend. So new leaders, new sectors really emerge. Raamdeo ji, what are your thoughts? Is this a bend? Are some of the old leadership going to fall by the wayside? Is some of the new leadership really emerging? What are your thoughts?
I mean, still the event is not over. So full damage and full re-emergence, we can see in financial damages. But I can also see more permanent gain to telecom and technology. Today we have been able to talk to 1,000 guys all over the country, or maybe some people must be abroad also. I mean, I did one seminar just a week back where all the chartered accountants were hooked in, and 31,000 people were there in the webinar call. So, and it went flawless for 2.5 hours. So it's a very different world. I mean, the comfort with which all three of us are sitting in different positions, and all our 800, 900 people are sitting in different places. So I think this is I realized we saw how much technology is entering our life, but I think this is going to take to different levels altogether. So I think emergence of technology and all the technologies are riding on consolidated, what we call telecom space. And telecom has become so important now that you would like to forgo your breakfast but have a good 4G connection with you. I mean, roti kapda makan ke badle mein roti 4G makan, roti 4G kapda makan and then gaddi types. So I think the order of essentiality has changed, and I think it is going to show up in the leadership. These are large businesses, not many companies. So that definitely looks to be one in terms of businesses. Second, I think the big thing would be, see, like when Y2K happened, China was nowhere in picture. And it was US all over, US, Europe, Japan also. But China was like very, very, very insignificant. It was just about emerging. Some names were there, here and there. Newspapers were not that prominent. And China achieved $1 trillion in 1998. We achieved in 2008. So there was not that much of a scene in 2000. I mean, China must have been about 1.2, or maybe, yeah, they were growing at about 10%. So they must have been about 1.2, $1.25 trillion on the turn of the century. And today they are 14 trillion. So this is the China's story of last 20 years. And today, I mean, whatever little I understand, the hatred for China in every aspect of it is very, very high. And some of the countries like America and Japan and Europe, they are very explicit about it. Otherwise, in diplomacy, generally you don't speak so, I mean, I heard one hard talk on BBC last week, and UK, Chinese ambassadors to UK, who is a very senior kind of politician figure, who was there for 8-10 years. I mean, he was completely grilled by, I mean, as if, you are dressing somebody down in public in BBC. They say, you better go and see that. And the way they were, I mean, he was also not kind or anything like that. He's accepting mood or anything like that. So I think the mood is different. So this could be Indian decade at least. I mean, this could be a turning point for India. Not only because for a incremental, I'm quite sure the world economy will be fine a year henceforth or something like that, maybe a year and a half. There could be some dip here and there, but I think we'll be fine. This is something which is surmountable. So the world will become more prosperous. Today, world is about $90 trillion GDP, and in next 10, 12 years, even at 4% compounded, I think in next say 15 years, we will be about 150, 160 trillion dollar GDP. So clearly, the world is becoming prosperous, and now the turn has come. If we play our ball well, and oil has also succumbed to this pressure, and it has come down to more like 25, 30, 35. I don't see oil going back permanently to, in a speculative way, the way it went to minus 37, it can go back to 50, 55, 60 also. But I think on average, I would think that will be significantly lower than that of last year. And this puts India, after a long time, into a current account surplus kind of situation. In a normal situation, when export import is right, after a long time, we'll be seeing very comfortable inflow outflow of the forex, and hence with $475 billion of forex, and by chance capital flows start in favor of India if we handle it well. I think we could be sitting on a plus $500 billion kind of forex and very stable rupee. I mean, I would not say that what depreciation we have seen in last 20 years at about 2.5–3%. I think there should be, if oil remains low, I would be very surprised rupee depreciating significantly from here. But in the short term, anything can happen. So I think it could be an Indian decade. So that kind of leadership change. Once this is something like, what happened in software. I saw software, I didn't know difference between software and hardware in 95, 96. In 2000, all over our portfolio, 80% of my portfolio was only software companies. And today, from that less than $1 billion turnover export in 95, 96, nobody talks about it. We are $150 billion of export in the current year. And the current year also will see 5 to 7%, 10% growth in the dollar billing of software. This is the biggest success story of India. What can, these are a point of time, turning point. It can be, it could be for a lot of industries, it could be a Y2K moment for outsourcing. And so I think there is an opportunity for India. How it plays out as we go forward, that could be a thing. And then because of that, a lot of underlying industries can change. A lot of suppliers, a lot of logistic companies. And so it could be because it is very difficult to figure out how the show will open up post-COVID. Because COVID, we are in the thick of COVID. It is very difficult to figure out what all will break down, what will become positive. Very few things are very certain. In this unknown environment, it is very difficult to say what is certainly going to happen. That's why you have to be incrementally, you sit with cash or you sit with a top quality company. Whenever you see a bright stray of light, okay, boss, this is shining. This is bound to happen. There you put your bet, and then, whatever happens in the next 3–4 years, you take that particular call. So yes, this will give birth to a lot of fantastic companies, businesses. More, I would rather, since we are stock pickers, I would look at a lot of possibility of companies emerging from India.
The other thing, Raamdeo, is that once upon a time, the framework was obviously earnings growth, PE, and all the other valuation parameters. But right now, nobody has any clue about earnings growth for this year, and how soon we'll get back to FY20. So how does that change the way to, look at the future, the way to look at investments and to price stocks also?
Yeah. So yes, this will be confusion, and that confusion understanding what is the potential of the franchise. And you can see the growth of the economy, growth of the business, underlying businesses will be undermined for 6 months, 1 year, maybe even 2 years. But if you start seeing 8–10 years, India cannot die $2,000 per capita. And if we go from $2,000 to $4,000 or $5,000 per capita, certain businesses have to grow. Despite the degrowth in the current year, like we were talking about page industry today, and you were questioning the manager. So he said, sir, if 3 months there is no sales, the current year in 9 months, even if it is a at par sales, still year on year basis, it is going to be 25% down. And then year after that, it looks 33% higher, isn't it? Without any growth, it looks 33% higher. So I think a lot of these things will happen like that. But I'm more optimistic on a little longer term basis. Things will be fine. I mean, we have seen in 2008-9, it was a complete. I mean, in India, the pessimism was not so high, despite the collapse in the stock market. But in US, not only market collapse, pessimism also was there. Today, in the real economy in US, there's a lot of pessimism, but the stock markets are showing a lot of exuberance. And so that's the disconnect. That's what is happening here also. So one doesn't know. But I would still use the same framework. I would not change the framework, but it all depends on the estimates. So there are very few places where you can actually have some probable estimates of growth, because franchise is good or not, or whether it is going to remain good or not, that's not a big deal. I think at this point of time, having faith in the 5 or 7 years of any company or any bank or any NBFC is more important, and that's where it will give you an edge, because because you understand the company, and you understand the power of the economy and what it can do, and hence you will have what do you call understanding of intrinsic value that gives you an edge. But framework is not wrong. Getting the data for that is a key issue.
Yeah, Ashish.
Yeah, I'm just trying to pick some questions that we've got, and I'm going to ignore the stock related questions, because this is not the forum for stock related questions. But one of the things that I noticed in the AGM speech, whilst he spoke at length about 29 and the crashes of 87 as well as World War, he also mentioned that 1934, the birth of FDIC, was a turning point for the US economy. And he did mention that because of FDIC and the fact that they moved to a Keynesian kind of a model where they can stimulate the economy, now it may not be as bad as what we felt in 1929. So any thoughts about that? Because I mean, I'm seeing a lot of messages where people are saying that it was a very pessimistic kind of a address, and should they be worried about India, and how do they approach investing?
Yeah. So as I said, I mean, I'm not impressed by his track record of macro calling.
Right.
And on that call, anybody who's predicting anything, I would not
Right.
believe too much. I would believe. But then these are the old people, wise people. You have to listen and move with a caution. Basically, you have to move with a caution, but you have to do your own homework.
Right.
And and then the microeconomic understanding in 2019-29 and today, with such rich data you have, and you have very recently GFC in 2008-9. So I think the understanding of the economists and the central bankers is immense, and the power which has been entrusted to the central bankers in terms of printing money and doing stimulus and fiscal. I mean, 10% liquidity surge, 10% fiscal surge, literally zero interest rate situation. This all happened in 15 days. This is unprecedented. Even bazooka is not a good word. So clearly that is coming from the confidence and the understanding that how big is the problem. And instead of waiting for a month, let's do upfront without bothering about whatever is the consequence. The consequence of not doing could be far more serious than whatever is the consequence of doing a little more. Whereas in India, the thinking looks to be just the other way around. They don't want to be seen to be overdoing. Probably they are very scared of rating and all. I don't know whether you can run a country by what the rating agencies think, but I'm sure the bosses in Delhi, they understand it better. And they will calibrate it rightly at right point of time. But so these are very different times, very, very different times. And how the consumers will behave. Consumers are so extremely well networked. In 1938, we didn't know it happened in US types. You will read in next day in some magazine that economy slumped in US and there was a depression and things like that. Today, I mean, before Americans get up, you know about them. So the social network, your internet, your connectivity all over the world is so, I mean, like today, Buffett must have been heard by, I don't know how many million guys they must have heard. We are holding seminar on what he said. So this kind of knowledge spread and connectivity is unprecedented. So definitely authorities that we are very, very, well informed, and hence we should not be that much alarmed, by, I mean, the power of central bankers are also very high. So let's see what happens.
And secondly, sir, as far as my understanding goes, Buffett has never managed his portfolio in a way where he goes into cash because he feels that the markets are overvalued, because he's already got a cash machine on the insurance business. So all the fresh cash is what he's not deploying at this point in time. And whatever he had to sell, because again,
That he sold.
goes into length to discuss that he sold because he made a mistake, not because he wanted to get into cash. But yes, he said that I would like to keep more firepower than earlier because of the unknown situation.
I would think even selling like this is also a quite a first time behavior.
Right.
In fact, his biggest mistake was Berkshire itself. When he bought in, that's whatever, 67 or something.
The
He
textile
thought,
business.
textile business, it took him, it took him by 1984-85, he was still owning those textile mills. He was supporting that with all his cash and everything. So he had a lot of patience in getting out of the textile business. He was not, fire it out in 1 or 2 years, that kind of thing. So he didn't want to give pain to the labor, and he didn't want to surprise. And he took a lot of time to get out from the Berkshire Hathaway textile business. I think there was a lot of criticism in the earlier years and then he changed those 14 norms of what is that? That those rules are there, no, of his investing. What he calls it, those.
Right.
I think 2 years or 3 years back, he changed on the permanency of his buying, where he said, occasionally, if we don't find the business to be good, we will also resort to selling. Otherwise, it was a buy and hold forever. That's where we got this slogan, buy right, sit tight. So, buy right, sit tight doesn't mean that you hold it forever, irrespective of the outcome of the businesses. So, I think on the selling part, I think he has reconciled to selling businesses. I remember in Coca-Cola, when I was going in 96, 97, that time Coca-Cola was absolutely reigning like a king. And in 99 or something, at some point of time, it became extremely expensive. And then it collapsed. Later on it collapsed. And everybody asked him why you don't sell it. When it is very, very expensive. And there he said that sitting on the board and knowing so much about the company, it is not fair for me to come out of the board meeting and sell the stocks. That's what he said. And that's how, since the business is good, I bought at a reasonable price. I'm getting decent dividend return and earnings return on my original investment, not on the quoted investment. I'm fine. He was reconciled to, long-term dividend yield and all. But probably he'd be willing to sell if anything becomes very expensive also, he might be willing to sell. I don't know.
And Raamdeo ji, a lot of questions now around markets as well. People who are invested, what should they be doing? People who have cash to invest, which we get less of these days, but how should they be going about given this backdrop and whatever information that we are getting on a day-to-day basis?
I think first is the health check of the current portfolio itself. I think that is very important, because a lot of businesses will be broken down and the weak business will become weaker and strong business will become stronger. That I'm very clear about. The COVID impact will be very clearly, it will fall very harsh on the marginal to weak businesses. The guys who are struggling before COVID, I don't know whether they should even fight. And the guys who are doing very well, they will become completely blessed, because their market share will go up, all the clients will converge to them. And as the economy emerges from this in 6 to 8 months time, Those weaker businesses will never come up, but the stronger ones will take the businesses from that part of it. So clearly, I would definitely audit my portfolio, and first I'll shed all the useless companies, and I mean I should have that competence as a fund manager to figure out what is good, what is bad. That is one. Second is that I would not bother too much about making cash call fundamentally. I mean, I would put this money again into something which I think, which is what we are doing. We are reassessing the portfolio. The weights are being reassessed. We are buying into the newer businesses, some reallocation into one or two new businesses. So that work is on, but broadly we are 100% invested, maybe 95, 97% in some portfolios. But good amount of activity is on in terms of churning. At least 10 to 15, 20% of the portfolios are being churned from existing stocks to the newer stocks. Some of the stocks are what you call reassessment of the businesses going forward, and some of them are because we are getting better opportunity other side. In fact, in some cases they are booking profits and getting out there. So that is one thing. I mean, managing of the current portfolio. Second is that if you have the cash, I mean fresh cash, I mean you can keep timing, but I would say that since nobody know, I don't have any special knowledge of where the market is headed, but only kind of confidence I have, reasonably good confidence that this problem is not a 60, 70 days problem. This entire COVID crisis is not going to be over in 60, 70 days, and it's a global problem. So unless the world, particularly US, is out of it, I don't think we are out of it, at least stock market wise. So I think we are still getting deeper into the mess in terms of number of reported cases. And but good news is that there are a lot of vaccines which are almost on the verge of on mass production. I hear this Poonawalla people have started producing some, millions of doses of some vaccines and all. So we are almost there in the sense that it could be a few months here and there. So I don't know which way to bet, whether bet on the optimism of finding a solution or bet on the challenges of continued COVID. So the world is divided 50-50, but I think damages are quite deep. It's like an explosion in a house. You can see the fire, you can see the smoke, but you don't know what is the damage. So when the bodies come out, as the quarterly results come, as the commentaries come, as the time passes, then you realize what is the extent of damage, and more than the damage, what it takes to bring back the party again. That is going to be like workers are displaced, public transport is not in place, there is going to be social distancing, there is going to be consumer behavior change, what discretionary people were dying to buy, probably they may not be willing to buy. What happens to housing market? Because these are large ticket items, whether people are, whether the lending institutions, whether they've got the liability and courage to re-lend, because the profiles of a lot of consumers will change. So a lot of these issues are going to come up as we go forward, and hence economy will take time to limp back to normalcy. So and that damages a lot of large, large, significant and weak businesses. So I would be very careful in laying out my money, and I would have some kind of systematic plan. I will go to the best manager if if he himself can do a very good job, nothing like it. But if he wants to pan out, clearly there are helps available, and I will go very, very measured tone. And I'll plan the play and play the plan. If I think that it is going to last 6 months or 1 year, I will plan in particular way that every first week of the next month, I'll put in this much amount of money, say out of, say 10 crores, I would put 1 crore every month, and 10 months I'll be done. So that's how I'll go about executing, because nobody has extra insight on this near term, and nearer you take, more hazy is the situation. Longer term, we are all bullish and things will work out, but I think really figuring out what is precisely going to happen in 6 months to a year is very difficult.
Right. Thanks a lot, sir. Navin, any closing thoughts? I mean, one of the things Buffett did was defend the index fund very passionately, and I think it was very timely that we've launched one, S&P 500. the US?
No, I think we were internally saying if you see Americans are very diversified in terms of the amount of emerging markets they own. Americans don't own 100% of their savings in America. They own a lot of global assets, right, and emerging markets because they are obviously wiser than us and their per capita is higher. They're more matured. They have wealth management firms who are doing this whole education of the clients like for the last 2 decades, 3 decades. In India, this whole wealth management thing is a relatively new phenomenon, last 10, 15 years, and it's only coming of age now. And there are government restrictions, right? So if you see across Asia, the relatively rich emerging markets, you take Korea, or you take Taiwan, or you take China, they're already, the wealthy people there have already started international diversification of their assets, right? But in India, unfortunately, there was really, on one hand, the government restriction was there of $150,000 and even lesser before that. But now you have hardly any funds. So the world's largest index fund is the S&P 500. Is by far the biggest in the world. And one of the most successful indices in the world has been the NASDAQ. So, we've launched both of these, and I think there are many more such exciting diversification ideas that anybody should consider because, if nothing else, rupee is depreciated at, over 5% per annum for so many years. So that's the least that you get. And on top of that, really in today's world, when you have some of the American companies like Google or Microsoft or Apple or you name it, if they are doing so well and they are even capturing the emerging market pie, there is no reason why an Indian investor should avoid these names or not look at these names. So the feedback that I'm getting across the board for this is that roughly 10 or 15% of the AUM should be into international assets, and I think people are moving in that direction. So I see this only a matter of time. I think over the next 5-10 years, I'd be surprised if any wealthy guy has less than 10% or 15% of his AUM in international assets.
Thanks, Naveen. Thanks, Raamdeo. It was a very, very interesting discussion, and it's always a pleasure to hear about Buffett from you. Just wanted to quickly summarize some of the insights that I got from both Naveen and Raamdeo. Of course, Buffett. This time it's actually a history lesson for people who are investing in markets. So I would urge all of you, whenever you get the time, it's out there on YouTube, and even the AGM minutes or transcript is there on the internet. If you are an interested investor or you're generally interested in investing, I think it's a great one to watch or read. Like Buffett says, never don't bet against America. And he at 31 years old, he says America is a young country. And I like your analogy, Naveen, that if America is a young country, we are an even younger country. And so if we've endured world wars and we've endured, and America has endured civil wars, so have we endured many such crisis periods. And I wouldn't remember, but maybe you or Raamdeo may know, during I think Indira Gandhi times, I think taxation was some 70-80%, if I'm not mistaken. And so we've had also our own set of crises, including 91, etc. So we shall endure this as well. And like Raamdeo said, I think what is important at this point in time is the time to create cash is over, but one must definitely do a serious quality check on one's portfolios and see if you have the right businesses and companies that will survive this crisis. Because like he said, companies which survive will thrive and probably become bigger in the future as they come out on the other side. We are doing that across our portfolios. There were a lot of questions on whether we are doing this in our PMS or respective funds. I can tell you from my conversations with Naveen, Raamdeo, or any of our fund managers, they're actively looking at each and every position across portfolios and and trying to improve quality. And we've done quite a few changes as well, which of course, whenever we have these webinars with individual fund managers, they will address. As far as fresh investments are concerned, you need to be cautious, you need to be careful and take your time, but more importantly, have a systematic framework, because otherwise often what I've seen is we get carried away by stories and our fears. And in hindsight, when we look at this period, we realize that it's a lost opportunity. So I think, and of course, the other point that Naveen made towards the end was, I think international diversification may be coming of age in India as well. In the past, because of RBI restrictions or lack of products, a lot of Indian households had only Indian exposure, whereas globally, emerging market diversification is something which is normal and most advisors do it. Now, fortunately, with the feeder funds that Motilal Oswal has launched, or there are others also in the market, you don't have a limit in terms of how much you can invest, and it's very easy. It's a rupee based product. You have long-term taxation. Of course, it's debt taxation, but it's simple, as opposed to, let's say, sending money out and maintaining an overseas account. So with that, I'd like to thank all the participants for tuning in and spending this evening with us. I hope you found this session enriching and insightful. Thank you very much.